Hello friends, welcome to my channel Finance Seco India. Today Tata Technologies just declared its Q1 financial year 26 numbers and they have shocked the market. Revenue plunged versus expectations. While profit still held its ground, stay tuned, we break down the why and what it means for investors. Make sure you subscribe for live result reactions. Before Q1, analysts were moderately optimistic. They predicted revenue of around 1,208 crore rupees, net profit at rupees 157 crore, EBITDA near rupees 171 crore, and operating margin of approximately 14.15%. However, the market sentiment was cautious. The stock was trading near rupees 700, already down 50% from its peak of 1400 post IPO, reflecting investors' concern over growth momentum. In short, analysts expected flat to modest performance, but the stock was already priced for trouble. Investors were bracing for a rough quarter. In a shocking miss, Tata Technologies reported Q1 revenue of Rs 740.8 crore, a drop from Rs 761.8 crore in Q4, and a glaring shortfall against the Rs 1,208 crore analyst has projected. That's a massive Rs 467 crore miss, over 40% below expectation. Why the drop? The decline stems from delayed deal ramp-up and macroeconomic headwinds, especially in automotive and aerospace engineering, their core verticals. If you compare it with Tier 1 tech peers like TCS or Tata Elxsi, they saw only marginal dips this quarter, not a plunge of this magnitude. Technically, the stock has been considering consolidating in the Rs 695 to 720 range. A drop below Rs 695 could trigger a slide toward Rs 650, while a breakout above Rs 735 might indicate a rebound. This quarter was a tough one. Major revenue underperformance, signaling deeper demand issues. Stay tuned for a management commentary that will determine if Q2 shows a rebound or a deeper slowdown. Friends, now let's talk about the profits. Tata Technologies delivered a strong Q1 performance. PAT rose 5.1% year-on-year to Rs 170 crore, up from Rs 162 crore last year, showing sharp sequential profit decline from Rs 189 crore in Q4 financial year 25. Operating EBITDA margin remained steady at 16.1% and PAT margin stood at 13.7%, both demonstrating robust profitability despite weaker top line. Why this resilience? Tight cost controls and disciplined working capital management sustained margin. Higher other income bolstered the bottom line, cushioning revenue softness. Looking ahead, management expects sequential recovery in Q2, driven by a stronger deal pipeline, improving client confidence. Tata Tech Q1 showed that even with slight revenue pressure, disciplined operation and financial resilience delivered profit growth, a promising base for future recovery. Tata Technologies reported a sharp revenue decline in Q1, driven by a demand slump in automotive and aerospace engineering, its core business area. A combination of slowing global EV spending and rising US tariffs weighted heavily on its results. In Q4, the company showed strength through new generation design wins, but this quarter told a different story. Instead of growth momentum, we saw broader cyclic pressure, auto major pulling back, delayed project start, and cautious client investment. Global macro dynamics like slowing EV adoption and geopolitical trade hurdles are clearly impacting engineering spend. Investors were expecting Tata Tech to ride through slower quarter more smoothly, but Q1 is a clear indication that recovery may take longer. To recap, Q1 revenue weakness reflects structural headwinds, not seasonal noise. The key watcher now includes management's commentary on deal pipeline ramp up and whether micro wars ease in H2. So let's discuss now what analysts are saying. Analysts entered Q1 with bearish technical, primarily watching the rupees 695 to 720 trading range. A break below 695 could trigger a drop to rupees 650, whereas a strong market reaction optimism guidance could push the stock above rupees 375. However, the revenue miss was so significant that it's forcing analysts to rethink their outlook. Despite a profit beat, the sharp top line raised fresh concerns. Bottom line, be cautious. The technical picture was already weak and the earning miss may delay any strong rebound unless management provides a clear roadmap. Let's now discuss about the risks and the red flags for this stock. Tata Technologies. Tata Technologies faces prolonged weakness in its core verticals, automotive and aerospace engineering, which disappointed investors expecting a smoother quarter. This isn't just seasonal, it's a structural slowdown. Several announced deal pipeline have been pushed back, signaling slower revenue realization and raising concern about deal velocity and client confidence. On the charts, the stock is approaching a critical zone between rupees 650 to rupees 620, where analysts believe that the market may increasingly price in going headwinds if no good news comes soon. In summary, the combination of core segment softness, deferred deals, and market sentiments pointing toward rupees 650 to 620 suggests the stock could enter a downside bias unless positive catalysts emerge. But it's not all bleak. Profit held strong. Tata Technologies posted a 5% year-on-year PAT increase to rupees 170 crore despite flat revenue, showcasing tight cost discipline and smart expense management. Deal momentum remains. They secured 6 strategic deals, including wins with Volvo Car and a European luxury OEM, indicating that the firm is successfully navigating the downturn and laying the groundwork for recovery. All eyes on Q2. If the macro environment improves and pipeline convert, the stock has room to bounce back. This quarter sets the stage. Watch for upcoming signals. Pipeline update, macro recovery and client confidence in Q2 will determine whether this resilience turn into a full-fledged rebound. So friends, now let's discuss about the upcoming triggers to watch. Q2 guidance and pipeline commentary. Management has already expressed optimism for a Q2 sequential recovery driven by strong deal wins and execution. Deal announcements. Keep an eye on update from major deals with companies like Volvo Car and European luxury OEMs. Sectoral recovery. A rebound in EV spending and aerospace capex would significantly support growth. So now let's discuss about the strategy for the long-term investors. If Tata Tech sustain margins and volume bonds, consider accumulating between rupees 650 to 700 as it could offer strong upside potentials. And for traders, watch critical level. A break below rupees 695 to 700 may trigger a slide toward rupees 650 to 620. Conversely, a breakthrough above rupees 75 could signal a strong technical rally. So the bottom line is that evaluate Q2 commentary and pipeline momentum first. If possibly returns, the rupees 650 to 700 band should be an attractive entry. Should play breakout more carefully. So Q1 is a tale of big revenue weakness but resilient profit, not a buy outright, but potentially a watch and wait zone around rupees 650 to 700. What are your bets? Dip buy, hold or skip this quarter? Let me know in the comments, and don't forget to like, subscribe and hit the bell icon for more detailed analysis of the company's quarterly results. Thank you for watching. Jai Hind.